If you were to diagnose the health of the American economy today, the latest Wall Street Journal survey of economists paints not a picture of unified triumph or despair, but a split screen of growth propelled by technological transformation and a job market cooling under the weight of political uncertainty.
Right now, artificial intelligence is a hot trade in the market. Data shows AI-related companies have contributed 80% of this year's U.S. stock market gains. As investment in the AI sector booms and tariff-related risks diminish, economists have raised their forecasts for economic growth while simultaneously lowering their outlook for the job market.
First, the much-hyped boom in artificial intelligence investment is transitioning from speculation fever into tangible corporate expenditure, boosting productivity in ways that are only beginning to be quantified. Second, and perhaps more politically resonant, is the fading of certain tariff-related risks. The Trump administration's deals with major partners like Japan and the European Union have, for now, created a patchwork of stability. The dreaded inflationary bite of these tariffs has also been milder than feared, adding a projected 0.5 percentage points to inflation rather than the previously forecast 1 point. In the grand theater of global economics, the curtains have momentarily parted on a stage less chaotic than many had dreaded. The very same economists who cheer the growth numbers are slashing their expectations for the labor market. This is the core of the American contradiction. Corporate investment is soaring, but corporate hiring is not. Companies, flush with capital and technological ambition, are investing in the silicon and software of AI, not in the flesh and blood of the American worker. They are cautious, hemmed in by the same political landscape that has provided a modicum of trade certainty. The persistent threat of sudden policy shifts combined with rising costs has fostered a climate where efficiency is prized over expansion and automation over employment.
The U.S. labor market is expected to remain a weak link. Economists forecast employers will create only 15,000 jobs per month in the current quarter, down from over 50,000 in the July survey. For the next 4 quarters, the forecast for average monthly job growth is about 49,000, down from the previous survey's 74,000.
Beneath these surface-level contradictions runs a deeper, more constitutional current, the fraying of institutional independence. The economists in this survey deliver a startling verdict on Federal Reserve. While they hold Chairman Jerome Powell in high esteem, with 77% awarding him an A or B grade, they gaze toward the future with trepidation. An overwhelming 79% believe the Fed will be not independent or only partly independent under his successor. This is a seismic shift in perception. This would mean that the interest rates, which are now being cut in response to genuine economic signals, like the job slowdown, could in the future be manipulated for short-term political gain. How this rift is resolved will define not just the next business cycle, but the very character of American power.